Hi, good evening, everyone. We'll be starting in about 2 minutes flat.
Trying to figure out how to share my screen on GoToWebinar because I've not used this one before.
Okay.
Do you know what how to share my screen?
There's something called sharing on the top.
Yeah, I don't see that one.
One second. One second.
Okay.
Sure, let's start now.
Yeah. Yeah, can you see my screen now?
Yes. Thank you. So I think we have a few people who have already joined in, and thank you so much for joining in at about 9:30 in the night for people logging in from India, and of course early in the morning for people in the US. A very quick brief about myself. I'm Anand K. Rathi. I'm the founder of Augment Capital Advisors. We started in the year 2010, and this July 10th we will be 10 years in operations. We primarily have clients in US, UK, Netherlands, and Singapore, and of course in India. We have offices in Bangalore, Mumbai, and Hyderabad, and we right now manage over $50 million of assets. And I've given a brief about Ankur Jain in my video yesterday. And just to start, he's based out of SFO and a very, very successful early stage investor. He's an IIT, Wharton, and UCLA alumni, and and found Emergent before. And started a couple of funds already. And I would be requesting him to take over the presentation now. Thank you.
Great, thank you, Anand. I'm glad to be here. So just to give a little background about me, if that's helpful. So I'm originally from Delhi. So that's where I grew up. Went to IIT Delhi. I studied computer science. I came to the US about 20 years ago. Came here for grad school, went to UCLA for a master's, also went to Wharton for an MBA later on. And I was fortunate to be part of two startups, one in late 90s. This was a company that had built a solution to make delivery of content faster on the internet. And we were acquired by a public company in 2000. And then another startup called Andiamo. We used to develop data center networking switches. And we were acquired by Cisco in 2004 for over $1 billion. And then I was leading a group in Cisco for a few years. About 10 years ago, I moved to venture capital. I was with a firm called Blumberg Capital in San Francisco. Blumberg manages about $450 million and invests across US and Israel. So I got very good experience there, also with Israeli ecosystem and understanding how they're building global companies out of Israel. After that, I was with another venture firm called Nexus Venture Partners. Nexus manages over $1 billion, and they invest across US and India. So I got a fairly good, again, experience and track record there, looking at both US, India investments. And between Blumberg and Nexus, I did about 13 investments with 6 exits and over 25% net IRR. After that, I did a startup, which unfortunately did not succeed. So I learned tough lessons there. Probably the hardest part of my professional career and I think I learned more there than I think I ever learned in all my 15 years put together before that. But that learning served me well, and then I came back in 2016 to start Emergent. Um, so we'll be telling you more about what we do and our what's happening in the market. Um, so we're based here in Silicon Valley, and we do what's called invest in intelligent enterprise software, and I'll tell you more about that. And the if I look at I told you about my background, and then my partner Anupam is also based here in San Francisco. Similar background in some ways. He also went to IIT Delhi Computer Science, went to UT Austin for a master's, went to and also MIT, and went to Wharton for an MBA as well. And he's also been a VC for 10 years at a firm called NGP Capital, which manages over $1 billion, and also a couple of startups before that. One called Meraki, which was acquired by Cisco, and then one called Winforia Networks, which was acquired by Motorola. So as I was saying, we've had a fairly good track record as a team, for over 10 years as venture capital, and before that as operators in startups. And we've had a track record of more than 25% net IRR over this 10 years. And we've invested in a few different categories. One I would call infrastructure software. This is typically software that is used to run in IT, these are things around storage, networking, infrastructure, security, but underlying things that power the IT globally. And you see some of these names, which are people in this industry know these names very well. And then the second thing is what we call application software. This is around software used to run business applications like sales, marketing, HR, supply chain kind of things. And this is and AI is increasingly being used in these kinds of applications in a big way. And again, you see a number of these companies that we have invested or operated in for over 20 years. And third area that we look at is what I would call smart mobility and marketplaces. This is around mobility is going through a massive transformation as we speak. And this includes whether it's on-demand models, whether it include models around self-driving, it's around new generation models for insurance. So this is another area that we have been investing in. So just to give you an overview of the firm, so we invest in what's called seed stage, which is typically the first money in the company, first institutional money in the company. We invest in intelligent enterprise software. This is software for other businesses. We're not doing typically, e-commerce or just chatting or those kinds of things. Typically, these are software sold to other companies to improve those companies, typically to increase revenues or to save costs or improve productivity in those companies. We've had a fairly good track record in the top quartile. In top quartile, the top 25% of the industry, the top 25% of the funds. It's a high bar, and that's what we have over 10 years tracked in the top quartile of our industry. So fairly successful track record. In a given fund, we invest in 18 to 20 companies, and we take about 10 to 15% ownership in a given company when we invest, and we're based in Silicon Valley. Our first fund started in 2016, and it's about a $30 million pool of capital, and we made about 20 investments from that. We're tracking to about 29% net IRR from that, and we had 3 exits so far, and we have tracked about 70% net IRR on those 3 exits. And currently, we are raising Fund 2, and we have half of that has been circled, and we're doubling down on the same strategy. And we are already made a few investments in that fund and continuing on that. So let me talk about what has been happening in the Silicon Valley ecosystem, especially in the current environment in the post-COVID world. Sorry, Anand.
Ankur, there are 3 questions. Yeah, there were 3 questions that have come our way. One, this is one of my own questions is, how did you guys meet up and decide to form Emergent, and what's the story there? And it would be great if you could share one of your smoothest investment story. In the sense where you thought you will do the numbers in about 5 years or 4 years, and then you ended up doing it in 18 months. This is one question. And then second, you mentioned that Emergent 2 series is open, and how long is it open? It was written there that it is a core fund. So does it mean that it's more of a follow-on fund to series 1, or how is it? If you could put, give us some details on that.
Yeah, so good question. So let me talk about each of those things. Let me talk about how we met. So initially, I started the fund by myself. Um, but Anupam, I have known him for 20 years. He also went to IIT Delhi, and he initially came in. He was still with NGP Capital, which is the billion-dollar venture capital firm I mentioned, and he initially came into the fund as an investor. He was an investor in the fund. Um, but as we started to make progress, and he could see the progress we're making, and also the thesis resonated very well with him. The kind of investments we were doing, the stage, the focus, it is something that his expertise was also in that, and he was also feeling that a newer, younger firm with a smaller fund is the right strategy to go to attack and generate high returns for that segment. So we both had a lot of synergies, and he decided to join me as a partner. That's how we came together. And he also had a very successful track record behind him. He made about 15 investments, 15 investments at NGP Capital, and 5 of those have gone into $1 billion or more in value. So very successful track record there. And yeah, so that's how we came together. In terms of the series, yeah, so it's open for a few more months. There are some benefits of coming in earlier versus later, but it's open for a few more months for people to come into that fund. And the core fund, so what we have is we typically lead these rounds at the seed stage. When I mentioned we come in, typically we write check up to $1 million and we take a 10 to 15% ownership. We'll typically take a board seat or board observer seat. And this fund we're calling the core fund. And then what will happen is, as these companies are growing, there is a future rounds of capital, Series B, Series C. And at that time, the companies which are really breaking out, it becomes very competitive. Everybody wants to invest in these companies. The valuations, of course, are higher at that point. They have, of course, more traction. But everybody in the world is wanting to invest. They're highly oversubscribed. They want to raise X amount of money, and people want to put 10x amount of money in the companies. And we, being early investors, we have what's called a pro rata, right? We have guaranteed allocation to their rounds, which gives us access to these companies which other people can't. So we would typically do a follow-on investment vehicle. We have an opportunity vehicle or special purpose vehicles to invest in these companies at that stage. So, so when I say core fund, just to differentiate, the core fund is the main fund that we lead the rounds, and then out of that $30 million that I mentioned, we also have an opportunity one. The core fund is $21 million, and then we have some special purpose vehicles which are used to further follow on the vehicles. And so, right now we're raising a $50 million core fund, and then we also expect to raise an opportunity vehicle separate from that, which will potentially take the winner and breakout companies and in the later stage rounds and do some investments there. So that's what I mean by that. Anand, does that make sense? Yeah. Did I answer that question? Yeah.
Yes, you did. So yeah, I would be happy to. I mean, you should take the next part.
Yeah.
Thank you.
And then there was a question on the example of a good success story that happened faster. So interestingly, I'll tell you a couple of interesting examples there. So one company we had, this was at Bloomberg Capital when I was at Bloomberg. It's a security company out of Israel called Cyvera, which we put the first money. We put the first money in the company at a $6 million valuation. We put in about $1 million investment at a $6 million valuation. And this was a security company. And of course, when we're coming to the company, our expectation was it will take, like any venture capital investment, will take 6-8 years for it to grow and succeed and all that. In 18 months, there's a public company called Palo Alto Networks. They really thought this product was very complementary to the Palo Alto Networks core product, and they wanted to come and acquire the company. And they acquired the company for $200 million in 18 months. So we got 20x our money returned in 18 months at Cyvera. Wow. Phenomenal return for us. Another company I would say at Emergent, we were invested in a company called Minjar, Minjar. Minjar was a cross-border company out of Bangalore. We led the first money in the company, and we helped this company come to the US market. In India, they had customers like Hindustan Lever, Tata Motors. They had a product for managing your cloud, but we helped them come to the US market. So the first customer in Silicon Valley, we had to put our credibility on the line to get them that first customer here in the Valley. We used to go to trade shows with them, stand on their booth, listening to what customers are saying and helping them refine the messaging for the US market. The company started to, after that, figure out the right product market fit and start to grow here. And then there's a public company here called Nutanix. We know the CEO well. It's a multi-billion-dollar company. And I was catching over coffee with the CEO, and we were just talking about the portfolio. He's really expressed interest to meet Minjar. and I arranged a meeting, and then they said, yeah, we want to acquire the company. So
Okay.
again, when we invested, we thought it'll take some time for the company to do an exit, but they acquired the company. We got about 4 times our money in less than 2 years, about 85% IRR on that investment. So again, we got a good early sort of return there. But yeah, these are a couple of examples I would say that I can share from that.
Thank you so much, Ankur. Yeah, we can go to the next part if you're okay.
Okay. So what's happening in the ecosystem right now post-COVID? So the current what's happened is this this downturn or this COVID has affected different industry segments very differently. So there are certain sectors which I would classify in the red zone. These are things like travel and transportation, local businesses, your hair cutting salon or rest, whatever, all these things, and your hospitality and events, oil and gas, commercial real estate, automotive. They've been very, very badly affected. As you can see, some of these have, unfortunately, are going out of business because it's so badly affected. The second is I would put the more yellow sectors. These are seeing slowdown, but it's like a regular recession. I mean, you're seeing a slowdown, but it's not completely changing your industry in a huge way. But it's it's seeing a slowdown. These are regular industries, your regular IT services, your financial services, logistics, media, advertising, just regular heavy industries, things like that, accounting industries. And so you're seeing a maybe 20% slowdown there. And the third sector is what I would call the green sectors. These interestingly seeing actually a spike and actually increase in demand. So if you're in the remote work collaboration space, people are working from home, seeing a tremendous spike. People are talking about Zoom and phenomenal growth. Things in the cloud infrastructure, cloud, business continuity planning, enterprise software, which is about doing things on the cloud. I think they're seeing a big growth. Microsoft Azure had the best quarter, which is a cloud business. Anything local delivery, e-commerce has been a huge spike. Anything in-home entertainment, learning, fitness, gaming, phenomenal growth there. Of course, healthcare, telemedicine, and consumer staples. Those are seeing a very strong growth. Fortunately for us, we have nothing in the red zone. Things have been a portfolio either in the green or in the yellow bucket, and broadly the portfolio has been fortunately doing very, very well because the combination has been actually very good for us. And the other thing is that the different impact within the VC ecosystem specifically. So what I would say is the consumer local businesses have been more adversely affected. Things around the physical consumption, whether it's a physical product, those have been or physical sales process have been adversely affected. Larger late stage companies have been more adversely affected because if you're at a 50-100 million revenue, for you to continue your growth is harder in the current environment. But for an early stage business, which is like smaller, it's more easy for you to grow from 1 to 2 million versus growing from 50 to 100 million. And the analogy I was making on the physical versus the digital is for digital product, the gaming, you're talking about Netflix or others, those growth rates are very high even in today's environment because it's a digital product. Companies making a lot of losses, high burn, those of course more adversely affected. Companies with low burn rates or profitable, they are able to withstand today's environment quite well. And again, enterprise solutions which have unclear ROI versus companies which have very good short-term ROI. What in 3 months you get break even on this or 6 months. Those are seeing again, a better or lower impact. And finally, products which are more high-priced product versus more value-oriented products. The value-oriented products are seeing a lower impact or acceleration in today's environment. Interestingly, broadly the crisis is accelerating the adoption of digital technologies and automation. So anything around automation and intelligent software is increasing. People want to automate more because of the current environment. They're shifting to more cloud-based IT infrastructure. Remote work is going mainstream. So they're using more collaboration tools, remote work tools. There's a focus on what I would call supply chain resilience because supply chains have been affected. So they want to invest more in technologies and around supply chain resilience, around business continuity, that things have to be, maybe affected. So business should continue. They want to invest in contactless systems for payments, access control, identity management. They want to invest in things around vision, voice, gestures, biometrics to improve these contactless technologies. Robotics is seeing more interest around manufacturing critical goods, food, deliver goods, because they see that as the future. And smaller automated local factories and 3D manufacturing, AR, VR kind of capabilities are seeing accelerating adoption. And telemedicine, remote education, in-home entertainment, those kind of platforms are seeing increasing adoption. And what's happening is, a lot of people think that when things are bad, things will stop or technology innovation will stop. What people don't realize is a lot of the giants of today. These are some of the names people are familiar with. On the left side, I'm sure you know these names, consumer, but a lot of these companies on the right side, you may not know. These are enterprise companies, but these are multi-billion-dollar companies today. They were all started or initially funded during the last downturn, the 2008-2009 recession. So downturns have actually been a phenomenal place to start initially fund companies, which ultimately become great companies. Because a lot of the noise goes away. A lot of the people who are just they're just starting companies. They're not really committed to it. They're just starting because everybody's starting companies. They go away, and people who are willing to start companies, they are really even a downturn. They're really self-selecting. They are really driven, really passionate, and the idea has really strong leg for them to start company. So actually becomes a self-selecting segment that people who are starting companies now raising capital are actually the really top of the cream, and that actually is good for investments from that perspective, because we invest in those kind of companies at this time. In India, some of these companies you would know, of course, Flipkart, Zomato, Paytm were started all during this 2008-2009 recession. And on the B2B side, Freshworks and Nobi, Dhruva, all multi-billion-dollar companies right now, were also started or initially funded during that time. And so trillions of dollars of market capitalization has been created by companies seeded during the last downturn, interestingly. And if you look at the broader VC returns, these are actually VC returns as an industry over the last 20 years. And you'll see, I'll see the first green arrow. This is 2002-2003 recession. It was 2x as an industry. So this is the overall industry average. The good funds did 4, 5, 6x, right? But even industry, which includes very poor performers, this was 2x. And then the 2009 recession, you'll see this was 2.5x return. Again, this was industry average. Again, this includes the fund which did very, very poorly as well. And the good funds again did 5, 6, 7x return. So these are actually the times when the average returns of the VC industry have been actually very good because of, again, the factors I mentioned there. For emergent ventures, just to dive a bit deeper into what we do, there are 3 core gaps and opportunities in seed investing that I'll talk about. And the progress our fund has been fairly strong, about 29% net IRR. And we've had a fairly strong track record, and I'll talk a bit about that. And I'll talk about our fund too. So what we're doing is we're investing in intelligent software, which is really creating trillions of dollars of new market value. And what I mean by that is, if you look at broadly the evolution of software, about 30 years ago, companies were essentially taking your pen and paper processes and making it digital. So that was 80s, 90s was around that. Then was a growth in cloud infrastructure. How do you do things, better user interface, on demand, instead of installing things on your desktop, just go to the web and use it. In the last 10, 15 years has been about that. And we see a lot of, each of these waves has created trillions of dollars of market value. The new wave is around intelligent software, which is on how do you use techniques like artificial intelligence, machine learning, more intelligently to bring the power of data. And so what we're seeing is confluence of these technologies like artificial intelligence, AR, VR, blockchain, cloud, big data, IoT, putting all these technologies together to change the way enterprises do their business operations, whether it's finance, supply chain, sales, marketing, HR, recruiting, customer service. All those functions are changing dramatically by a combination of these technologies. And that's what we're investing in. And just like in the past, this wave is, again, we see for the next 10, 20 years, a significant driver of new solutions, new market value. And we expect this to create, again, trillions of dollars of new market value through that. And in the company, this is typically enhancing their productivity, efficiency, and capabilities for enterprises. And we've been fortunate that a lot of our people who have been pioneered this intelligent software in the last and are continuing to pioneer this today. These are founders of successful companies. All these companies are multi-$100 million, billion-dollar companies which have been created in Silicon Valley, and are leaders in that. The founders of all these companies, as well as a lot of the companies which are being executives from these companies, they're all investors in emergent. Um, and what we're seeing is a lot of these people are helping us, not only sending entrepreneurs from their network to us, but also helping our portfolio companies with guidance, mentorship, connections, and also acquisitions. So we've got about 75, 80 such seasoned executives and founders from the industry who are investors in emergent, and that's a big extension of our reach and power. And they're providing us great insights and number of connections, which have been very helpful to our portfolio companies. What's happening now? I'll talk about the three key trends. Global enterprise startups in the US-India corridor are really taking off in a big way. And we've built a very good edge in this India-US corridor. Unlike any, we've emerged, I would say, the #1 fund in this US-India corridor, the seed stage. So India is really doing to global SaaS or global software. Yes.
Ankur,
Anand,
can you
you have
hear
a
me?
question?
I think you're not sharing the screen.
The screen is
Your
not being shared.
screen is not visible.
Hold on.
Yeah.
Hold on.
Yeah. Good.
Can you see it now?
Yes. Yes.
Okay. So yeah, this was the last screen. I think then there was some problem during by GoToMeeting. Yeah. So I was sharing that these are some of the executives and founders from these leading companies who are all investors in emergent, and they've been a very good network for us. These are logos that you would recognize. These are some of the best known companies and successful companies in Silicon Valley.
So
And
now that we are on this, I just had a question, Ankur.
yeah.
So how many of your investors are a part of a board of the investee company? I mean, do you invite them to be a part of the board?
Yeah, so we've got a couple of people like that. Yeah. So for example, the founder of Yumi, I mentioned Yumi is a company here that went public in New York Stock Exchange. So over $1 billion exit. And the CEO of that, he's invested in Emergent, one of our portfolio companies. We also brought him as a board member there, for example. So yeah, selectively we would bring some of these people as board members, advisors to our companies as and when we feel it's the right fit. But a lot of them are also advisors, not necessarily always in
Something
board seats.
related to that is how important. Okay. So just related to that is how important is the board seat when you actually invest into a company and take about 15-20% of the stake?
Yeah, so usually we'll take a board seat or board observer seat. So it's important to us and to have board visibility. So about half of the companies have a board seat, half have a board observer seat, where we also are. So, but yeah, we are certainly, it's important to us to have board visibility into our companies.
Okay, and so we were just touching about America, India. I mean, I think we should continue with that. There was a question there, but yeah, you should just continue with that, I think.
Yeah. So what I was saying, the global startups in the US India corridor are taking off in a big way. And we built a very unique edge in that corridor. So India is really doing to enterprise global software what Israel did to cybersecurity. Interestingly, there are a number of advantages by combining the power of US and India for enterprise software. Silicon Valley has some phenomenal advantages in terms of access to the right kind of capital, partnerships, exits, also some kind of growth mindset and talent, which is hard to find outside Silicon Valley. At the same time, India has strong capabilities on technology talent around engineering and product. And by able to combine both of these, you essentially get the best of both worlds. And that we are seeing a phenomenal growth in that ecosystem. The number of companies which are following that model has grown about 10x in the last 4 years. And vast majority of portfolio leverages US India model. And we've, as I was saying, we've established ourselves as the #1 seed fund for this India US cross-border companies. A lot of these are venture funds in India. Some of you may recognize the name. These are some of the best known venture funds in India. All of these funds also partnering with us. When they look at companies where the primary market is US, they bring those deals to us, and they want us to look at them together with them. And we co-invested with all of these funds because they don't have expertise in the Silicon Valley market. So they want a partner in Silicon Valley who can help these companies here. And we essentially become the partner of choice in Silicon Valley for these kinds of for all funds in India. So we built a very good deal flow also from the funds in India in what we do. The second thing about what is there is we like to lead rounds pre-momentum at attractive valuations, and we bring a lot of this deep expertise around B2B software. So what's happened in the approach is there's of course capital in the market. We know there's a lot of capital in the market. Because of that capital, a lot of the funds, which were smaller funds in Silicon Valley, have become very large funds. What used to be $100 million fund is now $1 billion fund. And when you're a $1 billion fund, you can't write small checks. It doesn't move the needle for a thing. So a lot of those funds, which used to do the stage of investing we do, $1 or $2 million checks, they've become bigger, and they're doing these $5-10 million commitments right now because their funds have become bigger in the last few years. So at our existing firms like Nexus Venture Partners or NGP Capital, that's what we saw the opportunity. We were seeing our own funds, like Nexus started as a $100 million fund, but when I was there, is a $500 million fund now. So we were seeing our funds were getting bigger in size and moving more downstream and writing bigger checks at later stage. So we were seeing the opportunity for a newer fund to come in and fill that gap, which is writing these smaller checks and leading those rounds. And that's essentially why we created Emergent, to fill that gap we were seeing firsthand. And at that stage, the companies are of course younger. They don't have as much traction. So you need a lot more deep expertise, industry expertise, to understand which company will be successful. But the valuations are very attractive. Once we come in those companies at those valuations, once and they get more traction, then there are a lot of funds in the next stage who have a lot of capital, who want to compete and invest in these companies, and they're often putting money in 3, 4, 5 times our valuation once they get some more traction. So we're able to leverage that effect in our industry. And the third thing is we tend to be fairly involved after our investment. We tend to work with these companies very closely in helping them get to product market fit, develop the right use cases, develop the right target segment, build the right teams for the next stage, and also implement a growth playbook. How to do a capital efficient model, how to develop the right go-to-market strategy. And in this, along with our own team, as I mentioned, we have this 50 plus successful entrepreneurs execs, which we're able to leverage their expertise also to help our portfolio companies. And because of that, we've been fortunate to have a very strong track record. I already talked about our team. We have 2 other people in the company. We've got Alok Nandan, who's also a partner with us. Alok has been also from IIT, went to IIT Kharagpur, did his PhD from UCLA, and he was part of Microsoft's cloud business. He was one of the founding members of the cloud business at Microsoft Azure, and that is multi-billion-dollar business for Microsoft now. And then he's had 2 startups that he's been part of. One called Yumi, that went public, as I mentioned, and a startup called Tempo AI, one of the first startups applying AI for sales, and they were acquired by Salesforce. And Indra Singhal is also an alumni from IIT Kharagpur, and he has been a CFO to over a dozen startups in the Valley. And he's both a CFO with us and also an operating partner, helping our portfolio companies bring expertise in operations, finance, contracts, things like that. So we're able to, so that's our core team that you can see. We've been investing for over 10 years, and we've had over 50 investments over 10 years with 12 exits. You can see the track record. The top is the track record prior to starting Emergent. We did a number of investments at different stages, and you see the track record on the right. And the track record at Emergent, before we started a fund 1, we had a fund 0, which was essentially Minjar, was a 1 company fund. And as I mentioned, we got about 85% IRR on that, which we distributed back to our investors. And our fund 1, which is a $21 million core fund, we've tracked to 29% net IRR out of that. The portfolio is tracking very well. We have these companies both at the AI and application layer, as well as a number of companies at the infrastructure layer. And a lot of these companies are breaking out and have built good names for themselves in the industry. We've had a pretty strong track record that 2/3 of our portfolio companies have already gone on to the next stage, which is either a follow-on financing or a profitable exit. And these follow-on rounds have been led by tier 1, well-known, recognized VCs in Silicon Valley. Here are some of the logos here that many people may recognize. And the 3 exits we've had is 1 to VMware, 1 to Nutanix, 1 to SailPoint. Again, these top-tier companies in the US. So again, I would say we've had a very strong track record. Most funds when you talk about seed investing, their success rate would be 30 to 35%. But we've had more than 65% success rate in companies going to the next stage, which is unusual, and pretty strong track record there. I'll give you a couple of examples in the portfolio. Sorry, Anand, you have a question? Yeah.
Yeah. So first of all, congratulations on Observe AI being named in the Forbes top 50 AI companies. So there was a question that came in from one of the participants is, so is it all about numbers and vision, or do you also have some kind of a good feel about a certain company before you invest into it?
So great question. Let me take it. Let me hold that question on for another slide where we talk about what do we look for when we invest, right?
Okay.
I'll hold that question for that. But I'll
Okay,
come back to
more.
that. Yeah.
Sure, no worries. One more question was, once you exit, what do you do with the fund? I mean, that is a process that you might want to detail us a little more.
Yeah. So what happens is the typical life of the fund is 10 years, and that's the nature of venture capital investing. It's long-term horizon investment, and the first 5 years is the investing period. When people commit to an investment, we don't call all the money up front. We call it over multiple years, about 20% a year on the average. So if we get exits in the first 5 years, we reinvest that capital back in companies. If we get after the 5 years, once we get exits, we distribute that capital back to investors as and when those companies exit. So if we get an exit in year 6, we distribute that returns back to our investors in year 6. When it's year 7, we distribute in year 7, and so on and so forth.
Okay, so I think so that one pending question, and yes,
yeah,
I think you should take it.
Yeah, so let me give you an example of portfolio. So this company, Observe.ai, interestingly, this is an AI cloud for call centers. So today, when you make a call to any call center, I'm sure you get this message. Your call may be recorded for quality purposes. So there's actually a QA team that is sitting in these call centers. They will sample about 2% of the calls manually. They will listen to these calls, and then they fill out a report of what happened in these calls. The problem is they're only sampling 2%. So if you had a bad experience in talking to one of the call centers, most likely they'll never hear about it, because likely you'll not be in that 2% that they listen to. Then the quality of the work that they're doing is very average, because they're not the most highly paid or motivated people to do this job. And also, their staff is leaving, all the time. New people are coming in, so the quality of the work is quite poor. So Observe is using an AI-based solution to automate this QA and compliance in a big way. So we're using Observe.ai. You can now do quality assurance on 100% of your calls for 50% fewer people, and you do a much better quality of the work. So it's a very compelling value proposition. So we led the first money in this company at a $3 million valuation about 3 years ago. This company has been going phenomenally. Now has 100 plus customers across US, Europe, and Asia, and they raised about $26 million, about a few months ago. The company is essentially we're about 10x up on our investment in 3 years in this company, and the company is on a phenomenal trajectory. The way the company is going, it can potentially be in the IPO track. There's a $300 billion that companies spend on call centers. Out of that, $10 billion is spent on QA alone, and the company is emerging as a leader in that category. We own about 10% of the company. We own the board of the company. Just one company like that alone can essentially return the fund or more, the way it's tracking. So hopefully that gives you some perspective of the kind of companies, the game-changing companies we invest in, with very deep technology behind them. I talked about Minjar, so I will not repeat the story. This company was acquired. We got 85% IRR on that. I'll give you a final example. A company called Talview. They're in the recruiting space. They use video interviewing to help interview people and reduce the hiring time from short 2 months to, let's say, 2 weeks. They've got, and today's with COVID environment, anybody who's hiring people has to do it remotely. So the demand has really gone through the roof in the COVID environment. The last quarter, the Q2, was their best quarter. They've closed most customers than ever before, and they're growing 100% year over year. And they've got customers like Amazon, Walmart, Deloitte, Pearson, and we led the first money in the company. And there is a Series A last year. We got about about tier 1 investor. We're already about 2.6x in about 2 years in this investment. But hopefully that gives you a flavor of the kind of companies we're investing in. Again, for both these companies, Observe.ai, Talview, Minjar, their engineering team was all in Bangalore. but the headquarters is Silicon Valley. The CEO of Silicon Valley, the sales and marketing is here, engineering is all in Bangalore. So they use that model of combining. And the rest of the world doesn't even know they're in India, right? So the US customers, they're a US company in their eyes. Headquarters Silicon Valley, the US corporate company, and they are just like India's US company in front of their customers when they look at these customers. So talking about fund two, we are same model. We typically lead rounds, 18 to 20 companies, and our typical check size is $500,000 to $1.5 million. And so doubling down on the same model, which has been working very well for us. And the smaller venture capital funds, they tend to be have very deep expertise and can outperform larger funds, which is what we've been doing. Typically, the track record over the last 30 years is the smaller funds, they outperform the S&P by 150 to 200%. So that's, and the emerging firms, the small firms like us, typically account for 40 to 70% of the VC returns because the smaller funds outperform the larger funds in a bigger way. Let me actually answer the question around people had around what we look for in the team. So, so this is some of the things we look for. We're looking for obviously high quality markets, big teams. Sorry, big markets and high quality teams. But we're investing in people who are on a very rapid trajectory of personal growth, and that's what we feel to be a very high predictor of companies to achieve that high level of success. So we're looking for founders who have a very high level of self-awareness of what they know, what they don't know. Because only when you realize there's so much that you don't know, can you grow and evolve quickly. We look for founders who have a very high level of energy and intensity for the long haul. Right? These are people who are the next 5, 8, 10 years who can keep going on without getting tired. Right? And money is of course a driver, but a secondary driver for them. But these are driven people. You put them in a football game, you put them for working for a nonprofit, whatever they do, just are driven in that. They're passionate about whatever they do. And that's just the nature of these people. And finally, people who are very strong inner balance. No matter what life is throwing at them, they're not shaken easily. As your responsibility grows, as your titles grow, as your company grows, more things go wrong in your day than less. People think, if you're CEO of a company, if you're engineer, think, their life is good. I've got so many issues. The reality is the more your responsibility, the more things go wrong in your day every day. So being able to deal with that, it takes a certain level of strength of your inner balance. So these are some of the key traits in people we look for before we invest. Did I answer your question, Anand? The people, what they were asking?
These are, a lot of qualitative factors, right? So
Correct.
how do you assess these? I'm sure you, not just with one meeting, you decide all these. It takes some time to build this.
Yeah, so it's again a pattern recognition business. Over the last 10 years as VCs, we've met thousands of entrepreneurs. We've worked with dozens of entrepreneurs. So it's about observation, very close observation of a lot of characteristics, what works, what doesn't work, and observing the traits of entrepreneurs in action. So like you said, we typically don't invest in a meeting, right? We're typically observing the entrepreneurs for a long time, sometimes for years. Some of the entrepreneurs we invested in, we've been tracking them for years, over their journeys, over their past track records, over their past companies. We would take them to prospective customers. We will have these people pitch to the prospective customers. We'll see how they respond. People may ask them difficult questions. We see how they handle those difficult questions. If there are some gaps in their thinking, we see how they take that feedback and come back in a few weeks or months and refine their positioning or thinking. So you observe them closely, and that's how we determine some of these qualities. But it's a lot of it about observation, very close, and it's about our experience of working with thousands of entrepreneurs, observing them to see what qualities are there in these entrepreneurs. If that makes sense.
Okay, and so there are two questions. Has COVID been positive for you overall? Has it affected your invested companies on a positive side? That is one. And one more question is, what is the minimum investment and how's the schedule right now? What is the drawdown schedule right now?
Yeah, so the COVID has been a net positive for us. Of course, some companies, I would say some companies have been affected, but nothing as in the sense that they're threatening their business. It just means their growth instead of would be lower. But number of companies are seeing positive, like company I mentioned, like Observe.ai, Talview, they're actually broken through their quarterly numbers, actually doing better. And are so in the last 5 weeks, while you would think markets are down and nobody's investing, 5 of our companies have raised follow-on round at higher valuation than what we
Right.
invested in top round. So, in fact, Observer.ai recently was Forbes nominated that among the top 50 companies in US in AI field. So overall, our portfolio is doing very well. In fact, we have actually accelerated our IRR is actually now more than 30% actually, based on some of the recent valuations and others, based on external
Right.
markups. So yeah, so COVID has actually been net positive for us. And the adoption, I mentioned, a lot of these technologies clouded. The adoption of technologies only increased. More people are now realizing businesses, they need to have these cloud-based technology. They need to have remote work. They need to have more automation. So the importance of these technologies has only increased. The people are feeling they need to be more technology-based in their approach. So that has been a
Right.
big driver. So in terms of the fund returns, so yes, with the fund, typically the way it works is the fund. Let me actually go to the right slide. Before I come to that, let me talk about the drivers of why people invest in emergent. Right? What some of the generally there are a few different things. One is obviously to generate returns. That's what people are looking for, and success to us means 25% higher net IRR. That's what we are targeting as success. Then it's a fairly good diversification. Early stage venture tends to have a low correlation with other asset classes. So what I meant by talking right now is a very good example. While the other markets may be down, but early stage venture, because our success is driven by these younger companies, and they are primarily driven by their own teams' executions. Whether the overall S&P is going up or down, or Nifty is going up and down, has less to do with their fortunes. So it's actually a very diversified asset class. Does not have a lot of correlation with other asset classes. So it's a very good diversified in the portfolio. We also bring in certain deals for co-investment for investors, so they can co-invest in certain deals which are very high potential. Also, there's a very strong network. I mentioned we got very successful entrepreneurs, execs from the community who are invested in our fund. We do a number of events with these people, including virtual events. So yeah, they get to be part of a very strong network, which is unique. They also get to learn on the cutting edge, what's happening in the industries with AI, software, and a lot of them can be used to inform their own strategies for their own businesses and work they do. And finally, a lot of our investors themselves, they want to give back. They want to mentor and help these newer entrepreneurs. So a lot of people do that. For investments, typically people commit to a certain amount. Let's say somebody commits to $250,000. Typically, it'll be about 20% a year drawdown. So about 50K a year is what we're drawing down over multiple years. And for India investors, this is something that we are a US-based fund. So they invest via the LRS scheme. They can invest money in US through the LRS route. And it's an opportunity for them to really participate in global innovation outside India, which is a very good diversification for their other asset classes that they own in India. And it's a fairly tax-efficient structure because in Indian investors, it's long-term capital gains is typically what these gains are. And US does not withhold capital gains taxes for non-residents. So they pay taxes in India based on long-term capital gains in India rates. And for US investors who are based in US, these are long-term capital gains. And companies that we hold for over 5 years, they are qualified for what's called, typically qualify for small business exemption, in which case they'll be exempt from federal taxes. So yeah, let me pause there, see if I answered the question that came in.
No, so are investors able to get QSBS tax benefit is one of the questions that I've got.
Yes. So if we invest in a company and we hold the investment for more than 5 years, and typically our biggest exits will be over 5 years whole time, they typically qualify for QSBS. So which means that the US investors those gains will be exempt from federal taxes.
So only those which are over 5 years. Is that what you're saying?
Correct. That we hold for. That's a QSBS only applies that you have to hold a company for over 5 years. But a lot of our biggest, which will be our 5, 10, 20x kind of returns, will typically be over 5 years whole time. So a lot of the gains in the fund will be over that, will meet that criteria.
And what is the minimum investment in the drawdown schedule?
Yeah, so minimum is about 150K. And I had already mentioned drawdown schedule is about 20% a year average drawdown. It could be plus minus 5% in a given year. It depends on the investing pace. But the broader on the average is about 20% a year drawdown.
So 20% over I mean it's 10% in 6 months and things like that, or how is it? I mean, today if I want to commit.
So today, somebody were to commit, it'll be 20% right now. We're already 6 months. The fund has already been 6 months when the fund started, and they'll be sending 20% to us right now. We expect to do another capital call in October, so there'll be another 10%. There'll be, and then probably another 20% next year. Note that investing, if people have not invested in venture capital or private equity fund, it's not like a fixed timeline. Hey, I send this money at a fixed. It's not a fixed time window. It is based on investing pace,
Right.
and we call it based on that. But average is about 20% a year. Typically, we'll expect to call next year 10% the first half of the year, 10% in the second half of the year. So, and this year again, it'll be 20% right now, other 10% in likely in October. That's the expected schedule.
Yeah. So while we will talk about charges next, there's one more question which says if you invest for less than 5 years, you get something called a 105 exchange. Are you doing that? 1045 exchange, sorry.
Yeah, so we are a pass-through entity. So our we're investing in private companies, and the gains which are long-term capital gains, short-term, mostly it's long-term. We issue a K1 to our investors. They get a K1, and yeah, at their level they do whatever. I don't understand how exchanges work, but if they have exchanges and they're signed, they take that money and reinvest that back in something else. They're free to do that, and the tax is something that they file at their end.
Okay. Okay. So yeah, then can you detail us more about the charges? I mean, how does the fund work, fund management charge and things like that?
Yeah. So on the charges is similar to any other venture capital fund. How the model works, we have an average 2% annual management fee. This is on committed capital, and that essentially is sort of pays for our regular sort of salaries and expenses. And then we have 20% carried interest. What that means is after the original principal is returned back to the investors, we share 20% of the profits. That's how the model works.
Okay. I think yeah, these were the few questions that I had come by. Okay. So is there anything else that you want both for people outside of India and in India to note about this fund in particular?
Let me see. Yeah, I think we talked about that. I think yeah, I mean, we had the start in QSBS. Yeah, I would say I think we covered most things. I would say it
Right.
is the technology trends. I would say what I see on the ground are only getting bigger, and so the underlying technology is things like AI and software. I would say the adoption is going at a phenomenal rate, and I would say we have the unique opportunity of taking a ringside view and seeing those firsthand, and I think trillions of dollars of market value will be created in this wave of intelligent software. And I would say if we have the opportunity, even if we capture a piece of that, I would say we are looking at very, very phenomenal gains from that.
Okay. So I'll just see if there are any other. Yeah, one other question is okay. It's a view. I think it says 1045 exchange allows to invest tax-free in another startup within 60 days. So I think it's a view. It might be a statement, I think.
Got it. Yeah. So when we do reinvest, as I said, during the first 5 years, when we get exit, we reinvest it back. So yeah. So we typically we would look to reinvest in 60 days. We did for 2 exits, we recycled capital, and we recycled within 60 days. So we did in that case, those taxes get deferred. Those taxes are not paid right now. Those taxes get deferred until the final exit. In that case, we did that.
Okay, so we'll wait for
one other thing I would mention. Some people when talk about risk in terms of startups. So when we invest in these startups, we have what's called liquidation preference. So what that means is, let's say we invest $1 million in a company, and when the company has any kind of exit or liquidation, we get our money first before the founders get any money in the company. So our money is at a higher preference, which is either a preferred stock or what's called a convertible note. So yeah, that again reduces our risk significantly when we invest in these companies, because we get the money first in these companies before founders.
Okay. So on the risk, I mean, good that you got this. So many people view venture capital as the high risk, high return category, and they generally allocate very little money. And so do you subscribe to that view that it is high risk, high return kind of an investment?
So venture capital is a unique asset class, right? And it is an equity investment. So like any equity investment, there are risks involved, as you would do any kind of equity investment. Having said that, the for our kind of strategy, which is coming in early and enterprise software is the most acquisitive market in the world. So a lot of our companies which are not being successful or not very successful, even those companies have had very good exits, 10, 20, 30, $40 million exits. We've often gotten 2, 3, 4, 5x on our investment, even companies which are not very successful, because a lot of larger companies, Cisco's, VMware's, Salesforce, they want to acquire these good teams and technologies. So that significantly mitigates the risk from a portfolio perspective. So if you look at the broadly venture capital, even the bottom quartile, even the lowest, which are the worst performer, lowest performing funds, if you look at their returns, even there probably you would see the loss rate maybe 10, 20% is what they've lost. So, but the gains, the top fund, the gains have been phenomenal. So I would say on a risk reward ratio, I would say it's a fairly attractive proposition, is what we've seen. And from a big picture perspective, if you look at how it fits in the market, if you put money in a, let's say bank account, right, you get whatever, very low interest. You put money in a fixed deposit,
Right.
you get higher rate of interest. So the market knows that when you're giving up liquidity, the market has to compensate with high returns. So in a venture capital compared to public markets, you are tying up money for a longer period of time, but the market has to compensate with high returns to make up for that. Which is why if you look at all these endowments, institutions, high net worth individuals, family offices, the money that they don't need for the next 6 to 8 years, this is the money for their retirement, or this is money for their future planning they want to give to their kids. They put a lot of that money in private equity and venture capital, because we don't need to sell that tomorrow. But if putting money in public stocks, you're actually giving, there's a price for that. There's liquid, you're paying a price in lower returns, but not getting a benefit for that because you don't want to sell it tomorrow. So there is for that reason, public venture capital outperforms or has a higher return and so it's a good asset class for money that you don't need for the next 6, 8, 10 years. More money for the kids, for the retirement, those kinds of
things. Long-term horizon, particularly.
Correct.
Right. So I think we are done with all the questions, and I think it was a great presentation, Ankur, and thank you for covering it in such a short time. And I think attendees will be happy to hear that the fund is trending well. In fact, I'm happy particularly because a few of my clients have already committed to this fund. So I'm hoping they would see 29-30% kind of an IRR. And if there's anything else, yeah, thank you so much, Ankur, and looking forward to having more conversations with you in the future.
Thank you. Thank you for having me here. It was great to talk to all of you. Bye bye.
Right. Thank you. Bye bye. Good night.
Bye-bye.